Welcome back to Investing Talk Podcast. Today we're focusing our analysis on a name that generates a lot of buzz and, frankly, a lot of volatility. Opendoor Technologies. They're the big player, the leader in tech-driven iBuying. And the central question we're tackling, one many of you are probably asking, is pretty straightforward. Is now actually a good time to buy this stock? If you enjoy this kind of analysis where we sift through the noise, please do remember to subscribe, like this discussion, and drop a comment below. Also, seriously, if there's a specific company you want us to look into next time, let us know in the comments. We do read them. Okay, so let's set the scene a bit. Opendoor operates right where technology meets the, very cyclical, high interest rate real estate market we're in now. For anyone maybe less familiar, iBuying means they buy homes directly from sellers, fast, using tech, sort of cutting out some traditional steps. But the stock, it's been on a real roller coaster, massive swings. So our mission today is to cut through the static, the macro worries, the earnings misses, those endless buyout rumors, and give you some clarity on the real risks and maybe the opportunities here.
It's definitely a timely analysis because, the stock price often feels, disconnected from traditional fundamentals. It reacts so strongly to interest rate news, to speculation. We need to separate signal from noise.
Okay, let's start right there. With the noise, we're definitely feeling market anxiety. What exactly has been pushing Opendoor around these last, say, 3 months? It's been genuinely wild.
Yeah, wild is a good word. The main thing has just been these overarching macroeconomic concerns. Specifically, investors are really anxious about the real estate market softening up, When mortgage rates spike like they have, Opendoor's whole model, which really depends on turning over inventory quickly and managing financing costs, it comes under enormous pressure.
And how did that pressure show up on the chart recently? Any specific moments?
Oh, yeah. We saw a couple of pretty sharp negative moves. First, back in October, around the 8th, the shares took a big hit, down about 8.61%. And that wasn't just like people taking profits. It felt more like that persistent worry about rising rates really hitting home, choking off housing activity. And that drop just makes the market look even harder at management, right? Can they steer through this? And even before that, September was rough too. That was mostly the reaction to their Q3 pre-announcement.
The pre-announcement. What went wrong there?
Well, the numbers showed they weren't transacting as many homes as expected. Volumes were below forecasts. And they were still losing money. Those operating losses just continued. That kind of 1-2 punch. It caused trading volume to spike. People were definitely reacting. And critically, it led to several analysts downgrading the stock.
Downgrades? Like how bad?
Some firms cut their price targets way down, and a few stuck with or even initiated outright sell ratings. That sends a pretty strong signal.
Yeah, that's some serious institutional pessimism. What about the big funds themselves? Did we see movement from ETFs or hedge funds adding to the swings, maybe late summer?
Absolutely. We saw significant moves back in late August, partly driven by passive funds. When those big ETFs rebalance their holdings, it can cause these temporary but noticeable price bumps or dips for stocks like Opendoor, especially with its high trading volume. Plus, around the same time, filings showed some hedge funds were cutting their positions. And, when retail investors see the smart money selling, it tends to fuel more bearish feelings,
Okay, so that paints a clear picture. Lots of market nervousness, lots of reaction to external stuff.
Yeah.
But we can't just trade on nerves.
Yeah.
Let's shift gears. What's actually happening with the business itself? Under the hood, how are the fundamentals looking?
Right, and this contrast is maybe the most important thing for you to grasp. Opendoor has built up truly massive scale in its operations. But, and it's a big but, getting to sustain profitability. That's still the major hurdle.
Okay, give us some numbers. How does that scale versus profit trade-off look?
Well, the scale is impressive. Trailing 12 months revenue is sitting at $5.18 billion. That makes them, hands down, the leader in iBuying volume. No contest there. However, that scale comes at a steep price. The company reported a net loss of $305 million over those same 12 months. That works out to a loss of about $0.43 per share, trailing EPS. And the core issue, really highlighted in the source material we looked at, is that their gross margin is just very thin, super thin. That reflects how competitive the space is, plus the cost of just operating during a housing downturn.
Wow. So $5 billion in revenue suggests they are moving houses, but that thin margin means there's not much profit left on each deal. Does Wall Street see that changing anytime soon? Are analysts optimistic?
Not really, no. The analyst consensus is still pretty conservative precisely because of that margin problem. Most are forecasting continued losses, probably well into fiscal 2025. The only way they really see improvement, maybe some modest year-over-year gains, is if, and it's a big if, the housing market finds its footing and maybe financing costs ease up. They kind of need the macro winds to shift in their favor.
Okay, so if they're losing that much money, how management handles the balance sheet? That must be absolutely critical. How's their financial footing right now? Are they stable?
Management seems very focused here, which is good. They're emphasizing prudent risk management, trying to deleverage. We saw, for instance, a recent strategic cut of $329 million in their financing capital.
What does that signal?
It tells the market they're actively trying to reduce debt pressure and manage inventory risk more carefully. Now, debt is still high compared to equity. That's kind of typical for a business holding lots of real estate inventory, but the reports suggest their liquidity is currently sufficient. They can meet their ongoing obligations.
I noticed when reviewing the sources, tracking consistent free cash flow seemed tricky. Was that a point of concern?
Precisely. It's hard to pin down consistent positive free cash flow from recent filings. That's not totally shocking, given the iBuying model involves constantly buying and selling, reinvesting capital into inventory. It makes traditional FCF metrics jump around. But long term, achieving sustainable free cash flow will be the ultimate proof point for their whole business model. That's what investors really want to see.
Okay, so despite the losses, despite the margin pressure, they are the clear market leader. Why? What gives them that edge? What's their competitive moat against rivals like Zillow or Redfin?
It really comes down to technology and operations. They were the first mover, the innovator in U.S. iBuying. Their advantage, their moat, is built on their proprietary stuff. Specifically, those sophisticated pricing algorithms they use and their digital platforms for handling transactions. These algorithms, in theory, let them react to local market changes faster than traditional methods and predict values more accurately.
Interesting. And what about how they interact with the traditional real estate world? Are they trying to replace brokers entirely?
Well, what's fascinating is their strategy there. They haven't tried to completely sideline traditional brokers. Instead, they've actually formed strategic partnerships with some of them. This helps reinforce their network. It's like they're plugging their tech into the existing system, not just trying to tear it down. That could really solidify their position as consumer habits keep shifting online.
Right. Okay. So we've got the picture. Huge scale, very thin margins, a strong tech advantage, but all happening in a really tough macro climate. Let's turn to the chart now. What are the technicals telling us? Segment 3.
Okay, the chart. It definitely shows that volatility we talked about, but interestingly, the technical patterns underneath suggest there's still strong buying interest despite all the swings. The longer-term price action has actually been quite bullish recently.
How bullish are we talking? What was the move?
Massive, actually. The stock staged this really aggressive recovery. It came all the way up from a 52-week low of just $0.151, believe it or not, to hit recent highs near $10.87. Right now, it seems to be consolidating, finding a range between about $7.57 and $9.50. But crucially, if you look at the chart, you see a pattern of higher lows.
And what does that signal?
That's a classic bullish technical sign. It implies that whenever the price dips, buyers are stepping in consistently, absorbing the selling pressure. They aren't letting it fall back to the previous lows.
Okay, where are the key levels then? The lines in the sand investors should watch. Support and resistance.
Yeah, the key technical support level looks to be right around $7. That level was a really important pivot point earlier in the year. Holding above $7 is pretty critical for the bullish case right now. On the upside, resistance is clearly marked at that $10 psychological level. If it can break through $10 and stay above it, the next likely target would be up around $12. And the momentum indicators seem to support this view. The stock's trading comfortably above its 50-day moving average, which is around $6.01, and way above the 200-day average down at $2.36. Plus, the 14-day RSI, a common momentum gauge, is around 54.29. That indicates healthy buying interest, but it's not yet in that overbought territory.
Hold on a second. That sounds almost entirely positive from a technical standpoint. But just minutes ago, we were talking about analysts slapping sell ratings on it with really low price targets. That's a huge disconnect, isn't it? Why should an investor trust the technicals when the institution seems so down on the fundamentals?
That is the critical tension here. You've hit it exactly. The reason the technicals might be holding up, even temporarily overriding that bearish analyst view, could be tied to that retail investor enthusiasm we mentioned. The strength we see on the chart might not just be organic buying based on fundamentals. It could be fueled by positioning people betting on potential news, like partnerships or even a short squeeze. So while analysts are rightly focused on the long-term margin challenges, many traders might be looking at the shorter-term catalyst window and the fact that, despite bad macro news, the price is stubbornly holding above that key $7 support. The technical suggests fear hasn't yet translated into sustained selling below that level.
Okay, that helps bridge that gap. It's about different time frames and motivations. Let's talk about what could actually break that tension one way or another. Technicals look constructive, but what specific events could really move the needle in the coming months? This is where it gets really interesting, segment 4. Upcoming catalysts and speculative buzz.
Absolutely. The next quarter feels pivotal. It's all about execution and direction, and it's driven by a mix of concrete dates and, frankly, some pretty potent rumors.
Let's start with the concrete stuff. What confirmed dates should be on investors' calendars?
Okay, the big one coming up soon is the Q3 earnings report. That's expected around November 6, 2025. This will be the market's first proper look at whether management's turnaround efforts are gaining any traction in this high-rate environment. Huge focus on margins and transaction volume there. After that, you've got a couple of institutional dates. There's the S&P 500 and general ETF rebalancing around November 18th, 2025, which could cause some flow-driven volatility. And then, really important, the institutional holdings disclosure on December 10th, 2025. That's when we see which big funds we're buying or selling during all this recent choppiness.
Okay, those are the knowns. Now, for the speculation, the rumors that often drive the short-term action, especially in a stock like this, what are the whispers making the rounds?
Right, the speculative buzz is definitely high. There are maybe 4 key things creating some froth in the market right now. First, there's persistent industry chatter about Opendoor potentially announcing a major strategic partnership. Think linking up with a large established real estate franchise. That could instantly give them access to new markets and boost their network effect significantly.
Okay.
Second, those buyout rumors just won't die, given their market leadership and scale, but the currently depressed valuation relative to peak, they remain this theoretically attractive target for, say, a distressed tech-focused private equity fund looking for established infrastructure they can maybe optimize. There's speculation about new tech launches, maybe new, even more advanced AI-powered tools for valuing properties or new services for home sellers. Anything genuinely innovative there could help justify a higher valuation based on their tech edge.
And the fourth one ties back to what you said about retail interest in the technicals, right?
Exactly. The stock has substantial short interest, lots of people betting against it. This creates the setup for a potential short squeeze. If Q3 earnings surprise even slightly to the upside, or if one of those partnership rumors turns out to be true, the technical picture is kind of primed. It could trigger a very fast, very volatile rally as short sellers rush to cover their positions. Retail traders are definitely aware of this possibility and likely positioning for it.
Okay, so we've laid out the tension. High fundamental risks versus strong technicals and potential catalysts. Let's try to tie it all together. What does this mean for you, the listener, thinking about maybe taking a position? Let's build the final investment thesis in this last segment.
Right. It boils down to that ultimate question. How do these very real high risks stack up against the potential upside from their market leadership and these upcoming events?
Let's quickly recap the key risks again. Beyond just the housing cycle itself, what defines the risk profile here?
Well, the stock itself is just very sensitive to the overall market. It has a high beta, around 3.6 here. What that means practically is if the S&P 500 moves 1%, Opendoor tends to move about 3.6% in the same direction. It magnifies everything gains and losses. So it faces constant risk from macro shifts, rate changes, and intense competition. But as we noted, management is signaling they understand the risks, focusing on cutting debt and managing liquidity. They're actively trying to navigate this.
So weighing all that, the leadership, the tech, the financial maneuvering, the technical picture, the catalysts, what's the overall take based on the analysis of our source material? Bullish, bearish?
Based on synthesizing everything we've discussed from the sources, the overall outlook actually leans quite bullish. We'd give it maybe an 8 out of 10 rating on the bullish scale.
Okay, what's the foundation for that bullish rating?
It rests on 3 main pillars. First, their established scale and clear technological edge. They are the leader. Second, that sustained bullish technical momentum we saw, especially holding that crucial $7 support level, that resilience is telling. And third, the fact that there are multiple tangible near-term catalysts coming up in Q4, the earnings report, potential partnership news that could realistically trigger significant upside movement.
So if someone listening is interested, what's the best way to think about the time frame? Is this more of a short-term trade or a long-term investment?
The analysis really suggests two potential plays. It looks quite attractive for shorter-term trading, specifically targeting Q4. You'd be trying to leverage those upcoming catalysts, the earnings, the potential news, for gains. Now, for a longer-term investor, Opendoor could be well-positioned for multi-year growth. But, and this is key, that really depends on them successfully executing their strategy, expanding their tech advantage, and on the housing market eventually stabilizing. It's an execution story that needs some external help.
That's a really clear conclusion. It really is a story defined by volatility, the absolute need for sharp execution by management, and these potentially significant near-term catalysts, all anchored by their undisputed leadership in iBuying.
And maybe that leaves us with a final provocative thought for you to mull over. The real long-term success story for Opendoor might hinge not just on surviving this housing cycle and finally fixing those thin margins in basic iBuying. It might depend even more crucially on whether their planned expansion into related areas, things like offering mortgages, title insurance, maybe even rental management, can actually be integrated successfully. Can they build a truly comprehensive platform that solidifies their moat against potentially much bigger financial or tech competitors? That expansion, that's the next chapter to watch. That's what could determine if they truly transform the industry long term.
Absolutely something critical to consider, especially as we watch those Q4 dates get closer. Thank you for joining us for this analysis today.